And I would say that is our sign, huh? All right, we'll call this meeting of the Finance Committee to order. Need a roll call, please?
Robert McPherson.
Here.
Sue Lunny,
Here.
Joe Wickelberger,
Here.
Paul Cardarella,
Here.
Sarah Whitley, Tom Wilson, Al Dazzle.
All right, and we will start with, let's see here, the consent agenda. There's only one item on it. So I'll look for a motion.
I move to approve the consent agenda.
I'll second.
All right, motion by Kristen, second by Paul. Any discussion? All those in favor, say aye.
Aye.
Opposed? And the consent agenda passes. On to public comment. Do we have anyone looking to speak? Not seeing anyone here. Anyone online? No one
Well,
there?
we're actually not. hybrid.
Oh, we're,
We
just
we're
video.
recording it, but we do have it webinar for our presenter later.
perfect. Okay. Then we'll move on to presentations.
Okay, I would like to introduce Justin Hoagland from Baker Tilly, who was our manager of the audit this year, and he's going to give a brief presentation.
Can you hear me? Did I press the right button? All right, sounds good. Well, as Renee said, I'm Justin Hoagland. I'm a senior manager at Baker Tilly, and I run the village side of your audit. We do have a separate team at Baker Tilly that does the utility side of your audit, and they issue like a separate standalone report. And I know they already presented to the utility commission and everything like that. We do include the utility numbers then in our report as a whole. But I'm not going to really hit on any of the utility funds during this presentation. So you should have drafts of the statements, of the financial statements and the reporting and insights. I hear it's common practice to have drafts at this meeting, and then we will issue. We're planning on this Thursday, as long as you don't have any changes or comments that or adjustments that we need to make to the drafts. So this is our first year auditing the village. I think we used to do it like 10, 12 years ago, but you did switch auditors this year. I'm happy that you selected us. I live in Kilkenny Farms, so this is the closest audit presentation drive I've ever had. So thank you for that. And so I'm going to go over briefly the draft reports that we have. So the first one I'm going to talk about is the reporting and insights from the 2022 audit. It looks like this. So this document has a lot of different information. It has a lot of required communication that we as your auditors need to give to those charged with governance yourselves. Any internal control issues that we noted, recommendations that we have. It has my contact info in there if you ever need to get a hold of me for anything. Again, a bunch of other information as well. The couple things that I wanted to point out on pages 6 and 7 of this report, we do discuss internal control matters that we found. And so, because Renee does so much, we have 2 points here related to segregation of duties that we had during the audit. Again, these are very common for municipalities your size, right? You can only have so many employees. And I would say, a lot of other places this size, we would have a lot more points than this. Sometimes we have a whole page of points, especially at our smaller places. So again, I would say that the village really does have good controls in place for the employees that you do have. On page 7, then we do issue what we call a material weakness over financial reporting. And that's for 2 reasons. Number one is the utility funds did have a couple audit entries that our auditors caught that were material. And because of that, we have to have a material weakness over financial reporting, because if we wouldn't have caught those entries, your statements would have been materially misstated. And the other reason is because we did have 2 restatements this year. So like I said, this is our first year as your auditors. I would say it's fairly common as when you have new auditors come in that you're going to have restatements, meaning there's numbers from the prior years that we didn't agree with. Again, having new auditors, new set of eyes looking at stuff, might have different ways of doing things and stuff like that. Restatements aren't super uncommon when you're switching auditors. So we did have two. The first one related to the EMS district and its capital assets. So we had a restatement related to how those were recorded. And the other one just related to, there was a loan within the debt service fund, I think it related to the Ice Pond loan, that we just kind of changed how that was presented. So I would say nothing out of the ordinary or uncommon with those. But again, that's why we had to have this material weakness of our financial reporting. We fully expect the village not to have a material weakness or financial reporting next year. So next, for the financial statements themselves, the one main thing I wanted to highlight is our opinion, which is on pages 1 through 3. And so we do issue a clean or unmodified opinion on the village's financial statements, which is the highest assurance that we can give. So all good on that front. And next, I'm just going to go over some of the financial highlights throughout the year, which is the presentation up here on the screen. So looking at page 1 here, when I'm assessing the financial health of a municipality, I always like to look at the general fund. This is the main operating fund of the village, where a lot of your day-to-day transactions run through. And so specifically, I like to look at the fund balance within the general fund. You might more commonly know it as equity. That's kind of built up over the years. So the black is kind of what the balances were in 2021. The blue color is 2022. And you'll see your fund balance kind of falls into a couple different buckets that we need to classify it as. And on the bottom of this page, it kind of describes what those different buckets are. But so to briefly go over them, for the non-spendable fund balance, and I'll say on pages 49 through 50 of the financials, it gives more of a breakdown of exactly what's in these buckets. But for the non-spendable, the vast majority of that relates to prepaid items that you have, and it's considered non-spendable because at year end you already spent it. Those relates to items you paid money for, but it's for 2023 services. So it's considered non-spendable because you've already spent it. It's not in spendable form. The next bucket is your assigned fund balance, 2.39 million at the end of 2022. So the village board can assign funds for various reasons. Again, there's a pretty long list of what all those things are on pages 49 and 50. You can also unassign them whenever you want. And so then kind of what's left over is your unassigned fund balance, right? This is what's, again, left over. It has no restrictions on it. The village can choose to do with it as you elect. So that's what that 3.28 million is. The other thing I want to mention on this page is the summarized income statement here at the bottom. Again, this is very high level of the general fund, kind of showing your budget compared to your actual for revenues and expenses. And so you'll see your final budget, you had actually budgeted to use about $971,000 of that fund balance up during the year, but you only ended up using $336,000. So you actually did do better than you budgeted by that $634,000 in the general fund. Again, wanted to mention that on pages 68 and 69, it gives a lot more detail of this budget to actual by specific line items. The one that'll probably stick out if you look at that is investment income. So you budgeted to have an investment income of about $130,000 during the year, but because of market conditions, you actually had a loss of about $350,000 on your investments. So that shows a variance of about $478,000. That's the biggest one that sticks out. That shows up on there. And I will say that's very common for other municipalities, unfortunately, this year. Many people had this investment loss that happened depending on what you invest in.
Can I just jump in really quick? So that's an unrealized loss. It's just a market adjustment. So, we've already recovered some of that in 2023 as the market fluctuates up and down, but it just was particularly bad right on, we have to market right on December 31st. And so again, because we plan to hold our investments till maturity, it shouldn't in the long term affect the village. It's just a market adjustment.
Yep. Oh, thank you, Renee. So going on to the next page here. So again, this graph focuses around the general fund balance. And so one ratio kind of that we like to calculate is we take that unassigned fund balance that we just talked about on the other page. We divide it by your budgeted expenditures. And so essentially this is saying if you took in no more revenue for 2023, how long could you kind of keep the lights on and pay your bills just using that unassigned fund balance? And so for 2022, it calculates out to that 27.7%, which is about 3.5 months. You'll see, at the bottom, the GFOA recommends a minimum of 2 months. So you're above that. That's what that black line is. The black line's your policy maximum. The red is the village of Wanakee. The blue dots are other municipalities your size in Wisconsin. So we have that we audit. And so you're in the 10,000 to 17,500 range of population size. So we have like close to 20 clients that we audit in Wisconsin that are within that range. And that's where those blue dots, that data comes from. So you are a little bit below what other municipalities are. The black line and the blue line, the village does have a policy that's you say you want to be between that 20 and 25%. Much better to be on over it than under it. But again, that's what those other lines are your policy. So then moving on to the next page. Again, kind of when assessing the financial health of a municipality, I like to look at its debt. And so this chart, the black line is your statutory debt limit, right? So the village can take out up to 5% of your equalized value in general obligation debt. So that's what the black is. That's your maximum of GO debt. The greenish line is the village policy for how much debt you can take out. So the village policy, as it says at the top, is you can't exceed 50% of that state limit. The red line is then what your actual debt outstanding is. And so you can see you're well below the state and your policy. At the end of 2022, you've essentially used up about 25% of your debt capacity compared to the state statutes. So again, you do have room to take out new debt if you choose. I would say the average for other municipalities is probably around 35% of the debt capacity used up. So you're a little bit below that average. So moving on to the next page. So again, this graph focuses around your debt. And so another kind of thing we like to look at is, what percentage of your normal routine expenditures do you have to devote to pay your debt service, right? Because if you're devoting it to pay debt service, you then can't use it to hire new employees, buy a public works truck, et cetera. So in 2022, you used about 28.1% of your normal routine expenditures went to pay that debt service. You'll see, again, you're pretty much in line with the black dots or other municipalities your size in Wisconsin. I will say you'll see that big jump or the jump down from 2020 to 2021. I'm assuming that relates to was that refinance debt in 2020?
We did. We had a large refinancing in 2020. So that really skewed the amount of debt service we paid because we were paying off some debt and refinancing it. So it just sort of messed up the percentage for that particular year.
Yeah, like Renee said, I would say it's artificially inflated that 1 year because from an accounting perspective, when you refinance debt, we have to show as this large amount being paid off and new debt coming on as expense and revenue. So that's why it just looks high for 2020. Also, I know that the village does have, as part of your policies, a percentage as well that you don't want to go over, and it is calculated a little bit differently than we calculate it here. I think your policy factors out any debt related to the TIF funds because those are eventually paid with TIF increment. So again, I just want to reiterate that this is calculated a little bit differently than how your village policy is. That's all that I have. Are there any questions or?
Anything?
Sorry, I'm a risk officer for my day job, so I'm used to sitting through this. I have kind of a odd question that I like to ask when I go through audits, which is from a qualitative perspective, did the audit firm have any issues getting information from the village or any resistance to anything?
No, Renee did an outstanding job. I forgot to thank her at the start, probably. First year audits are not fun for the auditor. They're not fun for the municipality, right? Because we just ask so many extra questions. We need to get so much extra documentation just to kind of understand the operations of the village off the bat. Then they get a little bit smoother. But Renee always responded right away. No issues with that. She does a great job. The only issue we had a little bit issue with the restatement of the EMS capital assets, just getting information from the other auditors, but we got it, and it no issues there. We feel comfortable with what we did. So all really good.
Thank you.
Oh, anything?
Maybe a question as it pertains to the general fund. In your professional opinion, what is your thoughts regarding the policy maximum as of today, and looking at the reference medium as the other subjects? Just curious what your thoughts would be on that.
Yeah, I would say that the 20 to 25%, I've seen that before at other municipalities. I've only have heard of one client that we've had where they've put in something that says, if we're actually over that, we're going to like transfer the money to the capital project fund or something like that. And that did not go well at the municipality. They eventually the general fund went way below the minimum. So I know I talked to our partner about that. He was he did not recommend editing the policy to have something like that. I would, especially a growing community like the village, I'd rather have that be a very healthy number, just so you have the money available for future projects. You can always assign more funds for future projects, and then that ratio is going to go down. So that's one way to just get that ratio down. Or instead of borrowing for debt, you could think about paying in cash for projects out of the general fund. Again, that'll make that ratio go down a little bit, but you're not very much over at all. So
Thank you.
And Sarah, anything? Anything from staff? Quick and easy.
right. Well, thank you very much.
Thank you, Justin.
Just thank you to Justin and the whole Baker Tilly team. And I think the utility audit went very well as well. So it was pretty smooth first year, I would say.
Yeah, agreed. Thank you.
All right, moving on to our business items. First one is discuss and take action on potential creation of additional fund balance policy related to use of unassigned fund balance in the general fund in excess of village policy.
Yeah,
anything from
I know
staff?
this is particularly of interest to one of your fellow committee members who isn't here tonight. So if you want to, make a motion to carry this over to a future meeting, that'd be fine with us. I know that Justin talked a bit about it in his presentation in terms of our current status. Paul, good question to glean information from him. Otherwise, I think it might make sense to carry it over.
I'll make a motion to carry over item 1, discuss and take action on potential creation of additional fund balance policy related to the use of unassigned fund balance in the general fund in excess of village policy to our next meeting.
Do we
I'll
have a-
second that motion.
All right, Kristen with the motion and Paul with the second. Any further discussion?
When is the next meeting anticipated to be?
We don't have it scheduled at this time. The next meeting that is for sure going to happen would be in October. but it's possible we might have an earlier meeting than that.
Okay.
All right, any other questions? All right, we'll call the question. All in favor, signify by saying aye.
Aye.
Opposed? Motion carries. So we'll cover that in the next meeting. Business item number 2, discuss and take action on assessment contract with Associated Appraisal.
We're gonna bring up Dean Peters. Dean is the lead from the company that run. Hey, Dean,
Good evening.
how are you?
Great. Can you hear me?
Yep. Thanks for joining us.
Wonderful.
So timing is actually pretty good because the revaluation / appraisals is fresh in the minds of our community. Dean, you and your colleagues there have been busy working on the village's process. Carla Endres, oh, by the way, is here in the audience. Dean, Carla's the village clerk and helps coordinate processes regarding open book and board of review on our end of things. So I'm glad Carla could join us. But we do have the contract coming up. Is it end of next year, Renee? Or
It ends at the end of 2023.
end of 2023,
So we
Would-
would need a new one for 2024.
right? And before we talk about renewing a process that we're used to, and that's a process where we set some money aside on an annual basis to build a fund to then fully cover a full revaluation of the entire village in one full swoop. In the case of this year, maybe Dean will talk about it a bit. We did a market adjustment, which wasn't as involved as going into inspecting properties as much, but is an allowable approach in some cases as well. That's what we did. But the circumstance is the same. You fall way out of whack with 100% value. In this case, we were at 81, was it? We were about 81% value to market. And then you revalue the entire village and everybody sees their value make a significant jump. In concert, then the villages and other jurisdictions mill rates will adjust down to kind of balance those equations out. But it is certainly a shock. There's a shock element for the residents when they receive that, out of sight, out of mind for 4 or 5 years, whatever. But you fall out of whack. It's not by choice when you come so far below in that equalized ratio, when the state requires the process of revaluation to come back closer to market rate. So it's not that we necessarily have that choice. And it creates confusion. And you've probably seen enough chatter in the past few weeks. What we asked Dean to do was talk to us about options that are available to us as a community. I have personal experience with this when I was administrator in Milton, when we switched from the typical method that we're used to a process called full value maintenance, where on an annual basis, all properties are revalued to essentially maintain as close to 100% year after year after year. And you get that reval letter every year, but it's not 20%, 30%, whatever change. It's a smaller market reflecting those 1-year adjustments. There's benefits to that approach. There's costs to that approach. And what I wanted to do was have Dean present those options and that process to you as a committee so we can talk about that. It really is a policy decision for you and the village board on whether you'd like to switch our approach. And I'd like to entertain that discussion with you to see if that's something we want to do as we move into a new contract on assessing. Did you want to toss anything in there, Carla, Renee, before we hand it over to Dean? All right, Dean, are you good enough to take it from there?
Absolutely. Thanks, Todd.
All right, thanks.
So let me just start by talking about what the state recognizes as the various scope of work that the options that the assessor has from year to year. So the Department of Revenue is the agency that regulates assessors in Wisconsin, and the Department of Revenue identifies essentially 4 different scopes of work that the assessor could perform in a given year. The least, I guess, the most basic scope of work is what they call annual maintenance. And that means that the assessor essentially accounts for physical changes to properties. That would be anything built, remodeled, torn down, and so on. Any new parcels that are created, annexations, land splits, new subdivisions, land use changes due to rezoning or potentially agricultural use, things like that. Anybody who requests a review of their valuation, and then we'd follow up on all sales and building permits essentially. So that's really the minimum. So you're accounting for things that are built and torn down and land divisions and so on, but you're not making any changes for market conditions in a maintenance assessment year. The next options all would allow us to make changes for market conditions. The next step up would be what they call an interim market update, which means that we are not only doing everything you would do under a standard maintenance assessment, but we are also adjusting assessments for market conditions. We could either adjust them to 100% market value, or we could adjust them to something within 10% of market value, essentially, is what the state says. And then the two larger scopes of work are revaluations, they call them, which means that we basically recollect all the data on all the properties. The difference between the scope of work I just mentioned, the market update, is we would use whatever data we have on file for most of the properties other than the ones that are having physical changes. But on a revaluation, we have either exterior or full revaluation. And in either one of those options, the assessor staff would have to visit all properties. We would essentially take new digital pictures, potentially check measurements. For exterior revaluations, we would just view the exterior of the properties, but for full revaluations, we would be asking property owners to schedule appointments for the assessor to come and walk through the insides of the homes as well. And traditionally, the village, I've been working as the assessor for the village, I think for about 12 years now. In the earlier years when I was the assessor, the clerk at the time was very adamant that we did the interior walkthroughs. And at the time, I think there was a year we did a revaluation where we walked through even 95% of the interiors of the homes in the village, which is really quite an accomplishment if you think about it. But times have changed, and nowadays there has been a Supreme Court decision that allows property owners to refuse entry to the assessor and still contest their assessed values, which was not the case 10, 12 years ago. And that sort of takes away the incentive of property owners to really have the assessor come and walk through the house if they still have the option to contest their assessment, even if they choose not to do that. And of course, we've had the COVID pandemic, and I think just the sense of privacy that people have in their homes, we've really noticed that when a municipality contracts for a full revaluation with interior walkthroughs, we used to get 60, 70, 80% walkthroughs. Now we're getting 20, 30%. So I think a lot of times it's been looked at by municipalities more recently that, hey, the only people that are going to have the assessor come through are the people that really want to cooperate. And those people who have done remodeling or finished their basements without building permits and things are going to choose not to have the assessor come in. So you're almost punishing the people who are cooperating at that point. So a lot of municipalities have said, why don't we just do exterior only? That's been really the trend in the last 3-4 years. But the state says that revaluations should be done once every 10 years, meaning the assessor should go out and look at properties, verify that we have accurate information by doing a walk around and so on. The last time we did that was in 2019. And then of course, this year we're in the middle of a market update. But most municipalities choose to do kind of an alternating revaluation every 5 to 7 years. And then in between, they will just do maintenance assessment. That tends to be the cheapest option, the least, expensive for the municipality is to do maintenance as often as you can. And then when you really need to do a revaluation, you do a revaluation. But as Todd mentioned, if you go that route, then you tend to have really big jumps in valuation when you do get around to finally having your reassessment. And so, this year we had a 31% average increase, for example. And I think what Todd was asking was, if there's other options out there that kind of allow us to increase values maybe more often, but in smaller increments, it might be a little easier on the public rather than having these big jumps. For example, the Village of DeForest is doing an option with us where they're having us update assessments annually. So every single year we send out a new assessment notice to every single property owner. And I've had mixed reviews about that. I mean, with the market conditions the way they've been the last couple of years, market conditions, we've still had 10, 12, 15% increases year over year. And so property owners are saying, well, why are you picking on me every year and reassessing me every year and making me go to open book every year? So there are other municipalities that are choosing to do an every other year market update, which still tends to keep the assessments more current, avoid the really big jumps, but you're not reassessing every year. And so these are some of the options we talked about. So I don't know, did everybody receive the handout? Todd, because I didn't bring a way to put that up on my screen. I
Yeah,
apologize.
the proposal that
Yeah,
you put together, yes, that
excellent.
was in their packets.
Okay, perfect.
Do you want us to bring it up on the screen so you can reference it?
Sure, that would
That
be,
help you?
that would be a great time for that.
Okay, looks like Renee's gonna be bringing that up here. Or I can share the packet here, Renee.
That might be faster.
All right. Anybody get a page number? Talk amongst yourselves. We just said that earlier, didn't we?
By the way, the revaluation this year is going very well. We've had a lot smaller attendance, believe it or not, through our open book process than what we expected. And property owners are very understanding. And so I would say it's going very well. Excellent. So what we put together here on the top part of the quote here gives you the basic cost of annual maintenance over looks like a 5-year term, 2024 through 2028. And that comes to a total of $262,500 over the 5 years. That would be if all we did was the minimum scope of work. And then if you wanted to add on kind of a la carte, a full revaluation, an exterior revaluation, or an interim market update, the extra costs are there. There is a line in between that says interior PRC questionnaire. That would be a supplement to an exterior only revaluation, and PRC means property record card. So essentially what we would do in that case is if the village wanted to have an exterior revaluation, but wanted us to in some way inquire about the interiors of the homes in terms of confirming bed bath count, finished basement, condition, quality, so on. We have a standardized mailer that we would mail out to all homeowners that we would ask them a series of these questions and ask them to return the questionnaire to us. And that would, kind of on a voluntary basis, allow property owners to provide us with some interior information, even if the scope of work was only for the assessor to view the exteriors. And if you look at the cost breakdown, the exterior revaluation is $175,000. Of course, you've got over 5,000 properties in the village that would need to get looked at. But if you look at the interim market update, it's significantly lower cost by more than $100,000. And the main reason for that is because there's a lot of costs associated with the assessor having boots on the ground and physically visiting all the properties and processing all that information that's gathered. For example, new photos, new measurements. That's just a lot of work. We can have up to 15 staff members working on that for months and months. And so that's a lot of additional cost to have that actual physical inspection of all the properties. I said earlier, the state recommends that be done every 10 years, although they don't police that. And if as long as the assessment records are reasonably good, you can get by with doing those more expensive on-site revaluations less often than 10 years. Below, we have an option, several blended assessment service options. And this would be where, I guess let's just go through them one by one. The first one is full value maintenance. And what this would be is the assessor monitors changes in market conditions over the term of the I guess 4 or 5 year contract. And the assessor would update assessed values annually, but keep assessments within 10% market value. So we may not bring assessments to 100% market value, maybe we bring them to 97%. If the market is really slow, and let's say we have a slowdown of this, this rapidly changing market that we've had over the years, and market values only go up, say 3% in a year, maybe we'll choose not to do any reassessments in a year like that because we're not in danger of falling outside of that 10% range. But in any case, it's kind of monitoring the changes in market conditions, making sure that your assessments are always within 10% of full value. The second one is full value maintenance with a 25% on-site interior inspection schedule. The one below that is a 25% a year exterior inspection cycle. The advantage of this approach would be rather than having the assessor boots on the ground visiting every property in the village all in one year and having that spike in the cost for that year, the assessor would visit 25% of the properties in the village annually, so that over the 4-year period, we would have visited 100% of them and satisfied the requirements of a revaluation. Essentially, you're getting your revaluation that the state requires you to have once every 10 years, but you're not paying for it all in 1 year and having all the public relations and stuff that goes into that in 1 year. The fourth line down is annual maintenance with 2 market update revaluations. So that would be essentially, it's almost like the every other year, I think. We would be looking at a maintenance year, then a market update year, then a maintenance year, then a market update year, then a maintenance year. And I really like that option personally. I think that accomplishes what we need to do to keep the assessments more incrementally increased, but it doesn't have us do the reassessment work every year and have people get reassessed, year after year after year. And the last option is a maintenance and an exterior inspection with the 20% over 5 years. So basically we are inspecting the exterior of properties. Instead of 25% a year over 4 years, it's 20% over 5 years. And all these different options might make your head spin a little bit. So that's why I'm here, I guess, to try to talk through and decide which option best fits the way the village would like to move forward. If you stayed status quo, you would choose annual maintenance for 5 years and in theory have $175,000 for an exterior revaluation at the end of that 5 years. The other thing I should note is if you choose from the top section, the monthly invoicing is for maintenance only, and any of these add-on options get invoiced on a percentage complete basis during the year that they're taking place. So if you chose to do annual maintenance on the top and then add on a revaluation, you would be invoiced for the revaluation all during the year that it happens. Whereas the options down below, which are blended, the entire price is just invoiced monthly over the course of the year. So your invoicing is even month to month and year to year.
I would note that, and confirm if I'm wrong, Renee, but we do budget an amount on an annual basis above the annual maintenance to establish funds on hand to put the big bill for revaluation when it hits. So there's not like a spike in that budget line.
Yeah, we carry over each year until, say, this year, 2023, when we're doing the interim market update, we already have some money set aside to make that additional payment.
So we don't think the finance committee today has to take an action to recommend whatever to the village board. We think that'd be asking a lot of you after you're having your first kick at the discussion today. Although we do think it's important that as we come to the end point of our budgeting process, which has already kicked off and completes mid-November, we would wish to have an accurate budget number in there based on the contract that we want to pursue. So that may mean kicking it around here today and possibly scheduling a special meeting with this on the agenda to talk again in the next month or two so that you can make a recommendation to the village board.
All right, anything else? Otherwise, any questions, comments?
Yeah, so to confirm, the existing contract today is going to be the annual maintenance and then reevaluation every 5 years. And with reevaluation, it's with the interim market update. Is that? a correct
Yes, the contract that was in place, I believe, was can't remember if it was 3 years or 5 years, but it ends this year. And it did have the option for the market update, which the village chose to have this year, which is the last year of the contract. So essentially, we need to have some kind of another contract in place moving forward for another 4 or 5 years.
And I will just say that we did do in 2019, it was also an interim market update. So it's not, in the way we've been doing it now, it's not necessarily every 5 years or any set
Okay.
period. It's when we drop below that, the 10% that the state requires us to be within for our equalized value, then we have to start the process of moving that percentage up. So like Todd said earlier, we were at about 81% last year. We need to be at above 90. So we did that process now because it helps us too when we're working on the tax levy and things like that, to not be super out of whack between the market value and the assessed value.
Yes, and it's worth mentioning that none of the revaluation options that we're talking about actually change the amount of tax revenue that's collected. All revaluations are essentially revenue neutral, but they can have an effect on the mill rate. If your assessed values get behind the times and your budget continues to increase incrementally from year to year, then your mill rate is artificially high because your assessments of your tax base are artificially low. So I think it's nice, to keep the mill rate down. That can be helped. That can happen when you have more frequent revaluations. The other advantage to updating assessments more often that I may not have mentioned is just the fact that it makes taxation more uniform. If you wait 5 years in between revaluations, there have been a lot of different changes in market conditions over 5 years. Maybe differences between residential and commercial property, or differences between condominiums and single family, or differences between older neighborhoods and newer neighborhoods. The more often you reassess, the more uniform and fair your taxation is.
Okay, other questions? Sarah?
I don't really have a question, but it's more of, I think the annual maintenance with the two IMU revaluations, I think makes the most sense. Because I know, like, with all the talk that has happened after the reassessments, so I mean, the market conditions the last couple of years, and there's been a lot of higher evaluations, but I think to keep things at bay, like, I don't know, could I put a motion on the table that we do that, or
I would suggest carrying out some discussion and,
more discussion?
yeah. But you may see some consensus that would lead you to a reasonable motion,
Yeah,
depending on that.
Maybe a quick question regarding the assessment. So you have 5 years of professional assessment services. Now that contract could be 2 years, 3 years, 5 years. You just create your own contract, or how does that work?
Well, I think the minimum that we offer as a company is a 3-year contract. But with what Todd was asking for some of these options that have a 25% inspection cycle, you wouldn't want to just do 25% for 3 years. You want to carry it 3 to 4 years so that you complete 100% of the inspections. And then some of these other options were for 5 years. So really you have the option of choosing a 3-year, a 4-year, or a 5-year contract, with the recommendation being that the longer term will lock you in at, these base prices. And it's more than likely that, with cost of labor and materials and fuel and whatever else it might be, that prices are going to go up. So if you lock in at a current rate, it might save you money in the long run for a longer term.
Thank you.
Okay, other questions from this side?
What's what are we seeing as an increase in cost between our existing contract and the proposed contract? Say we stick with what we're doing now, just do apples to apples.
I forgot to flip.
I forgot to get that information on what we're paying. You're saying like what 2023?
What's the increase gonna
Yeah.
be between the existing?
I can
contract
look
and this one?
pretty
Okay.
quickly as you continue discussing.
Okay. And then for clarification, Dean, on the annual maintenance, the 2 years that are asterisks, so I see where it talks about, full value maintenance option includes 20% annual exterior and the 2025 and 2027. So that's a flat statement though of it's all inclusive pricing. There, it's not an asterisk because there's going to be an additional cost in that year to do those services.
No, the asterisk doesn't indicate an additional cost. It just indicates which year the higher scope of work would take place. The invoicing would be consistent for all 4 or all 5 years. But the additional work would take place on specifically in 2025 and 2027.
Okay, is there a particular reason why that has to be a 5-year contract?
No, I mean, you could choose 4 and you could choose 2024 to 2027, and then you still have your 2 market update revaluations, and it would be essentially maintenance, IMU, maintenance, IMU.
Okay. Do you anticipate that would change the price if there was a desire for 4 years as opposed to 5?
No, the prices are the same. That's why I said it's just an advantage to lock in at 5 years because you get an extra year without any kind of escalation in price.
Okay. My only concern is in that type of a pricing scheme that we would potentially be in for a bit of a payment shock at the end of the 5th year if we have to do the IMU in year 6. So that's, I know I'd be reading tea leaves at that point to understand what the price would be, but I think that's the concern that I would have with that.
Robert, so I did look up, so because this is the year that we are doing the interim market update, it is the same price that he has on here. It's 67,500 was in our contract
Okay.
for the interim piece. And then our 5-year piece looks like that was 182,500. So we chose the option to pay it smoothly over the 5 years. So for example, this year we're paying 36,500.
Okay.
So,
And how much did we also budget for our set aside fund to cover revaluation years? That's different than 36.5, right? That's the contract.
right, so we've been budgeting 25,000 a year. In addition to that budgeted contract amount. So we, and plus we probably had some money left over from when we did the interim market last time. So we had 100,000 in the 4 years, plus some leftover money that we are using towards that interim market update.
That makes sense. We have a surplus even.
Yeah,
after
so
everything's been
even
done.
this
Yeah.
year, we would have an amount that we would carry forward toward future assessment costs.
All right, anything further?
I would also say that annual maintenance under the assessment services or the blended services seems to make sense to me. The a la carte prices for something like that seems like we would just be paying more if we decided down the road, so. Thanks for the explanations. I feel like I've got a clear understanding of kind of the choices ahead of us.
Just one question from me, and it kind of goes back to the whole general fund thing that we deferred there. When we take those extra funds, where are those residing? I assume they're not in the unallocated.
Right, so when we carry them over as we're building up to do some sort of revaluation, those are in the assigned that he talked about.
Okay.
So again, the board adopts the assignments. Those can be changed, but that's where it resides. So it's not part of that unassigned calculation
Just wanted to
that he
make sure.
talked about. But yeah, that's where those types of things sit until such time. So in the 2023 budget, though, I budgeted to use some of that that had been previously set aside to pay for the interim market update.
Okay. All right. Any additional discussion or direction? Do you have what you need for this period of time, or? Is there
Well,
something-
is there something that you would want to flush out further based on the options presented? Is there one option that you'd like us to really hone in on and give a better staff analysis as best we can at a future meeting? Or are you comfortable with the recommendation of the board? I mean, it ends up being, there's 3 of you here already tonight. It ends up being before the rest of them, but I don't know if you wanted to wait for more input from your other members of the committee who aren't here. Really is your prerogative, but I think that might bring us into the category of a special meeting. So we're not waiting till October. That wouldn't work.
And when you say special meeting, I mean, because finance doesn't have any regular schedule, so it's not really a special meeting, but it
Yeah,
would be a
right.
meeting that wasn't one of our sort of required meetings. It would be, again, August or September. I would not think we'd want to wait to have the finance discuss this again in October, because that doesn't give the village board time to process
It
it.
kind of sounds like a special meeting, doesn't it?
You want to call it that?
We've got a great finance director.
Every meeting of this finance committee.
They're
is a
all
special.
special.
meeting.
Yeah, there you go.
So what do you guys think?
We need to meet again to discuss policy, so I wouldn't see a harm in,
Good point.
I don't know that we need to make a motion tonight on that, though. But it does sound like everyone likes annual maintenance, so
Yeah, I think we're kind of
Yeah.
congregating.
I don't want to speak for
around that.
Paul, but okay. So I mean, if you need direction, we probably would want to focus on understanding the annual maintenance choice.
Okay, I think one other question might be, does anyone have strong feelings about, and Dean gave us some really good feedback on how things are changing in the assessment world in terms of inspections, interior, exterior. Does anybody have a policy position on feeling strongly that interior has to happen? Or are you ready to move on from that as a practice? Because then again, we can hone in with our proposal information if that's not an element.
I think less and less people are gonna let people in, like you stated, so I think I don't think we really need to worry about that as much, the interior side.
In the financial world, exterior appraisers or appraisals, wow, I can't speak, are becoming more and more acceptable as opposed to interior. So I would agree, there's no need to push for interior.
Okay, I think we can focus in
Yeah,
that
agreed.
direction then. And we are looking at another meeting then that we should attempt to schedule. right?
Yeah, so I will send an email out, kind of like I did for this one, though this one we had to postpone a month or so, to get Tom and Al as well in the mix on when they might be available.
Perfect.
A reasonable meeting then to also have that fund balance policy discussion. Renee,
Yes,
would
we
that
could
be okay?
hopefully have that as well.
Okay, appreciate the feedback. Dean, thank you.
Thank you.
Thank
Have a
you,
good
Dean.
evening.
Much appreciated. All right, we will move on to the next item of business. Discuss and take action on the preliminary 2024 budget process and calendar.
Yeah, so in your packet, I had put the tentative budget schedule for 2024. I think mostly everybody has been through the budget cycle, except for Robert, as your first year on the board and the committee, but I still think you're quite familiar with our process. But a lot of the items have actually already taken place. So the finance committee meeting to discuss the timeline, that's tonight. You know, we had hoped for a June meeting, that didn't work out. So a few things have already happened. I issued the request for capital and operating budgets. I've already received those back from the departments. So we're kind of already to the August part of the timeline, where that would be if any of the department heads needed to meet with their own committees to talk about budgetary needs. Then typically in September, Todd and I will meet to go over those submittals. And then October 16th has been the typical meeting where we present to the village board and the finance committee. Now, last year we did a joint meeting, and I did want to get the feedback from the committee members that were part of that joint meeting, how they thought that went. If you remember, we were all together.
I thought it went well personally. I don't remember. It was a long time.
Yes,
right?
it was. So we convened, basically we convened the finance meeting within the board meeting. So that the presentations, because we have all the department heads here, sort of doing some slides and things, are part of the presentation, so that we only did that one time for both bodies at once. So then so the finance committee was convened in the middle of the board meeting, and then that was a bit for efficiency, because in the past, when we didn't have citizen members, we just did it at the board level, because it didn't make sense to have finance with all the same board members. So that's why we tried that last year. So I would propose we do that again if there weren't any, if nobody has issues with that.
I think that would be a good
Yeah.
approach personally.
Good with that.
It's-
Anyone?
Is that October 16th on here, the set date for it, or is that?
Well, that is the third Monday of October.
Okay.
Which is when the normal board meeting would be.
Good.
And then there's the process of me sending the notice to the public hearing, or for the public hearing. And then the past number of years, we've had sort of at the first meeting in November, an extra emphasis on public comment specifically on the budget, so that we have time to take that comment and incorporate things rather than just waiting till the formal public hearing.
Yeah, previously it was public hearing and take action and we're done.
Right, and
Yeah,
there's
that
not
makes
a
pretty
lot
tough.
of give on that end date, because we have to get all the information to the county for preparation of the tax bills. So that's why we added the extra one, though we still are required to have the formal public hearing. And there would still be time it just wouldn't be as pretty to incorporate last minute changes into the budget, but it still can be done, obviously. And then looking toward that third Monday of November, the 20th, to be that formal adoption, so that we can meet our deadlines with the county tax bills. So any comments on that, or any other things that you think should be incorporated into the timeline or incorporated into our process that we have historically followed?
Anything from this side?
No,
I think efficiency is great. Bringing them both together. Monday, the 20th of November is the Monday of Thanksgiving. That's traditionally when we do it. It's always a busy week for you in particular. So yeah, I think that's for us, that's fine.
Yeah, it was that week last year.
Yeah.
I mean, I guess unless the board chose to have a special meeting a different day, I don't know if that's ever really been considered, but
No, we have to meet anyway.
yeah, so
Busy for you, like
Yeah.
a busy week for you.
Yeah.
Yeah, that week.
Um,
Yeah.
but yeah, it's worked in the past.
Okay.
Okay, any further discussion? Otherwise, I look for a motion to approve this.
I make a motion to approve.
Second,
All right, motion by Sarah, second by Kristen. I'll call a question. All in favor, say aye.
I,
Opposed? And the motion carries. And we are on to our last business item, discuss potential change to equipment replacement fund budgeting.
Yeah, so hopefully you've all read the summary sheet, but we're looking at maybe making a small change to the way we've adopted specifically the equipment replacement fund budget, which also includes purchases of new. It's not just replacement, but so in the past, we were able to adopt the budget in the third meeting of November. Department heads could place their orders for vehicles and equipment, and they'd still get them like sometimes really early the next year, or at least in the year that it was budgeted. But we're finding that it's very difficult still, and maybe forever, to get vehicles, even just, squad cars, certainly things like dump trucks, snow plow equipment is just a really long lead time. And so we were trying to figure out how can we work through that. And we thought maybe we could adopt sort of a rolling 5-year equipment fund. So that would allow people, if it was in the budget, they could place their orders so that they could get it in the year when they were going to need it. And again, then instead of, going to the board every time they needed to place an order a couple of years in advance, it gets very cumbersome, and sometimes they have to make a fairly fast decision if something's going to be available or not. So that was a thought, and I just kind of wanted to get feedback from the committee before we sort of proceeded that way and look to the board to do that.
Okay,
But any questions on that, I'm happy to answer. Or
I'll just throw one out there. Is there a particular reason for the 5-year versus 4-year or something? I mean,
well, so our current policy for equipment replacement has a 5-year attachment to it. So we need to maintain a certain balance in that fund over a 5-year period. And so that's why I chose the 5-year, because we're already kind of looking at the 5-year period. Now, our overall financial management plan that we do now is a 10-year. But once you get out, certainly past 5 years, it's a pretty big guessing game. And so the 5-year was kind of because that's how we've sort of been operating the equipment replacement, but we've never formally adopted all 5 years. We've looked at 5 years, but then only formally adopted the 1 year. So that's why certainly open to thoughts there.
would it be feasible to look at the 5 and adopt 3, or? I mean, we're kind of slicing things.
Yeah, I mean, I think that could be possible. I mean, I haven't heard of anybody having to go out further than that in terms of placing their orders. Usually it's, 2 years it's been.
Mhm.
So I do think that, yeah, I mean, the 5, that was just what I threw out there. I'm not absolutely set on that.
Okay. Robert, you look like you got your.
I was just thinking because in fire and EMS, I mean, we're doing the same things where they need to order something and it's not available for 2 to 3 years. And I'm assuming in most of these cases, we're kind of just locking in prices, saying that we're committing to it, because I think not everybody's even requiring like a prepay or anything like that. They're saying you can pay us when it's available, but you have to lock in your price now for something that you'll get in 2 to 3 years. Is that?
Correct. Yes,
Yeah.
we haven't seen where we've had to actually pay out the money in advance. It's just to get on the list for something to get built or ordered. You can't even get on the list unless you have a pretty decent commitment that you will accept that piece of equipment when that year comes up.
And are actually seeing most contracts that are long builds, not locking in a rock certain price. We're seeing inflationary or supply chain parameters, 10%, whatever, added on that we are without choice but to agree to. So locking in isn't even a thing anymore in a lot of ways.
Right, it's definitely still a very challenging situation, particularly for public works and police that have the larger vehicles and equipment.
Yeah, this feels sensible to me. Yeah, I would agree with it. I'd support it.
And from this side,
Yeah, I support it as well. Seems like it makes complete sense. So.
Yeah, I think the 5-year plan would work as well.
And to Joe's point about perhaps 3 years, maybe I'll talk to the departments that are most affected and see if 3 years would be a good option as well. Because again, that just reduces that rolling period and stuff. It's maybe easier.
my only concern would be from a, overall board standpoint, we're looking at the budget. Realistically, 3 years, 5 years, I mean, the village is not going to change so dramatically in that period of time that we're going to say, hey, all of these vehicles that we needed to replace, now we're just gonna forget it. So it probably isn't a big deal.
But yeah, good point, though.
All right. That give you what you
I
need
think
there?
that gave me what I needed.
Perfect. Well, then in that case, we are at the end of the agenda.
Move to adjourn.
Second.
Kristen with the motion to adjourn and Robert with the second. All those in favor signify by saying aye.
Aye.
Opposed? And we are adjourned. Thank you.
So we did, as you know, we did record it, so we'll make sure that